Okay, let's do a quick lightning round. 5 questions, 2 minutes for each question, and we'll have to analyze and answer the questions and draw some conclusions on what we've learned. Let's start with equities. Let's talk about dividend, X, and record date. The question could be, a dividend has been declared with a record date of Monday, July 15th. When is the first day a current holder of the stock can sell and still receive the dividend? To answer that question, we get a few options given to us here, and the key is for us to decide when is the earliest day that the holder can sell and still receive the dividend. Key here is to remember that for the holder to receive the dividend, he has to be the beneficial owner of the stock on the record date on Monday, July 15th. Now, given the regular settlement of stock trades on 2 business days, it means that in order to still be owner of record on July 15th, I still have to own the stock and couldn't have sold it on July 11th, 2 business days before. So Friday, July 12th is the first day that I can sell. If I sell on Friday the 12th, I will still receive the dividend. So the answer to the question is B. Couple of quick points to remember: declaration date, X date, record date, and payment date. The first and the last are somewhat arbitrary. X date and record date are the ones that are relevant. Next question. Let's look at the bond products here. Let's talk about nominal yield and current yield. Um, let's say the question could be, a bond with a 5% coupon is quoted in the market at 98. Which of the following statements is true? Is the bond's nominal yield 5.1%? Is the bond's current yield 5%? Is the bond trading at par? Or is the bond's current yield 5.1? Key here is to recognize the difference between nominal yield and current yield. Nominal yield is the coupon that is attached to the bond, in this case 5%. The nominal yield does not change during the life of the bond. It will always be 5%, and meaning a nominal value of $1,000 will give you 5% or $50 in annual interest. The current yield, however, is that same $50 per year that you get now as a percentage or a fraction of the market value, meaning the $50 that I get are the result of a bond I bought for $980. As a percentage, that is 5.1%. It's annual income divided by the market value. So we know that the bond is not trading at par. It's below par. We know the coupon, the nominal yield, is 5%. And we now know the current yield is 5.1, meaning the only right answer here is option number 4. So key points to remember: nominal yield is the coupon, the current yield is annual income divided by market value, and the yield and the price are inversely related. The yield goes up, the price goes down. Next one, maximum loss on a complex option strategy. Let's say the question could be, which of the following strategies will expose the investor to unlimited losses? And then we get a couple of options to choose from: a bull call spread, bear call spread, a short straddle, or a long straddle. We can spend a lot more time on spreads and straddles in general, but the key part here is to remember, when will there be a potential unlimited loss to an investor? Well, for starters, we know a spread will never have an unlimited loss. The spreads will be bracketed by a higher and a lower strike price depending on what we're looking at, a call spread, a put spread. If we're bullish, it's a bull call spread, otherwise it'll be bear call. But given the fact that it's bracketed between a higher and a lower price, there will never be an unlimited loss, so it cannot be a spread, so no answer A or C. It also cannot be a long straddle. A long straddle is buying a call, buying a put, and the most you can lose in that situation is the premium that you pay for it. So that leaves only answer B as an option, and the unlimited loss on a short straddle is determined by the fact that a short straddle is selling a call and selling a put. Selling the call, the naked call, gives you unlimited downside risk. So remember, spreads, the maximum loss is limited to the net debit. Straddles, the short call, can generate the unlimited loss. Let's look at suitability and investment objectives. Let's say the question is an investor wants to generate periodic income from his portfolio. What instruments would he most suitably invest in? And we get a couple of answers: blue chip stocks, growth stocks, value stocks, and corporate bonds. The key here is that in questions around suitability, the answer is often what is the best answer across a series of acceptable answers. In a lot of these different situations here, the investor will generate periodic income. Blue chip stocks will pay dividends. Growth stocks generally will not pay dividends, so there wouldn't be income coming from that. Value stocks will generate dividends, and so will corporate bonds, or at least they will pay interest. Key here is that the best option, given what we're talking about here, is answer D, the corporate bonds, because the corporate bonds have a priority over the stocks in terms of having the bondholders paid the interest. So although blue chip stocks are definitely a reasonable answer to this question, given that we're focusing on periodic income and we're determining suitability, corporate bond answer D is the best answer in this case. A couple of quick points to remember: growth stocks are about capital gains, have a higher volatility and more aggressive. Income stocks are about getting cash, are more stable, and are more of a defensive strategy. Last question, new issues and IPOs. Let's talk about syndicate roles and fees. The question could be, which of the following syndicate fees represents the largest amount in a new issue process? So the syndicate is the group of brokers that essentially are underwriting the issue for the issuer and bringing it to the market, and in return for that get paid by getting a lower price at which they buy the new issue and the ability to sell it into the market to investors for a higher price. So the question is, what are the different elements that are part of that spread between what is being paid to the issuer and the price at which it is sold to investors in the market? We get a couple of different elements here. We talk about concessions. The sale concession, essentially a reward for the brokers that are selling to the public. The manager's fee for the managing underwriter for taking on the risk and the responsibility of managing the syndicate. The total takedown, which is the difference in price that we talked about earlier, that the syndicate members will benefit from. and the additional takedown, which is another part of that spread. Important here is to recognize that the total takedown equals the additional takedown plus the concession. So by the very definition of it, that makes the total takedown the largest sum. Remember, the underwriting spread is the concession plus the additional takedown, and the manager fee, the total takedown, is the additional takedown and the concession, and the net issuer proceeds are equal to the amount issued minus the underwriting spread.